I've been around this game long enough to know that the market doesn't ruin most traders. They do it themselves. Not with ignorance, not with bad luck, but with a single quiet moment when they decide their rules don't apply this time. You know the moment I'm talking about, don't you? That instant when the tape is moving just fast enough to stir your blood, when the chart looks almost right, not quite right, but close enough that you start bargaining with yourself. Every trader I've ever known has had rules. Some of them were written down, some were only spoken inside the head. I won't chase price. I'll wait for confirmation. I'll cut losses quickly. Fine words. Sensible words. But rules are only rules when they are obeyed under pressure. When there's no pressure, even a fool can be disciplined. The market doesn't test you when you're calm. It tests you when you're excited, scared, or bored. Which one gets you most often? I learned early that the dangerous trades are not the wild, reckless ones. Those announce themselves. The truly costly trades are the respectable-looking ones. The trade that almost fits your method. The chart that is just a little late or just a little early. You tell yourself you're being flexible. You tell yourself experience gives you the right to bend the rules. But let me ask you this, when was the last time flexibility paid you more than discipline? A man doesn't break his rules all at once. He erodes them. First, he ignores a small signal. Then he widens a stop, just this once. After that, he adds to a losing position because the market owes him a bounce. Each step feels reasonable in isolation. Taken together, they are a confession that the trader has stopped listening to the market and started arguing with it. And the market, as you know, never loses an argument. The moment you break your rules usually comes right after a run of success. That's no accident. A few good trades make a man feel clever. He begins to believe the profits came from his insight rather than from following his plan. The chart becomes a suggestion instead of a judge. Have you noticed how easy discipline feels after a loss, and how difficult it feels after a string of wins? I've always said that the big money isn't made in the buying or selling, but in the waiting. Waiting requires rules. It requires knowing what you will not do as clearly as what you will do. When you break a rule, you are declaring that patience no longer matters. You're saying action is more important than accuracy. But ask yourself honestly, how often has action for action's sake improved your equity curve? Look at any chart where you broke your rules and tell me the truth. Was the information really new, or were your emotions louder than the facts? The market speaks in price and volume, not in hope or fear. When a trader substitutes his feelings for the market's message, he stops being a trader and becomes a gambler. And the market has infinite capital to wait for gamblers to make mistakes. I've watched traders stare at a chart, see a clear resistance level, and buy directly into it because they were afraid of missing the move. Missing a move never ruined a trader. Chasing one has ruined plenty. The fear of missing out is just impatience dressed up as opportunity. Do you really believe the market only gives one chance? Breaking rules is often justified as confidence. But confidence without restraint is arrogance, and the market has a way of correcting arrogance swiftly. True confidence comes from repetition, from knowing that if you follow your method 100 times, the results will take care of themselves. The man who breaks his rules is not confident in his method. He's confident in his impulse. Which one deserves your trust? There's also the matter of money management, which most traders nod at politely and then ignore when it interferes with their excitement. Position size is a rule, not a suggestion. Risk per trade is a rule. When you exceed it, you are no longer trading your system, you're trading your mood. And moods change faster than trends. Have you ever noticed how your biggest losses come from trades that were just a little too large? The market doesn't punish you for being wrong. It punishes you for staying wrong. Rules exist to keep small losses small and large losses impossible. When you override them, you remove the safety rails and then act surprised when the fall hurts. A trader who respects risk sleeps better than a trader who respects predictions. I've often said that a man must study himself as much as he studies the market. Your charts will show you patterns, but your behavior will show you your weaknesses. If you keep breaking the same rule, that rule is pointing directly at your problem. Is it impatience? Is it fear? Is it the need to be right instead of the need to be profitable? Wealth in trading is not built on excitement. It's built on consistency. Consistency comes from doing the same sensible thing over and over, even when it feels dull. Especially when it feels dull. The market will tempt you with movement, noise, and drama. Your rules are the quiet voice reminding you that boredom is often the price of survival. When you break your rules, you don't just risk money. You damage trust with yourself. The next time a valid setup appears, a small voice will ask whether you'll follow the plan or abandon it again. That hesitation costs more than commissions ever will. How many good trades have you missed because you no longer believed your own discipline? Every trader remembers the trade where he knew better and did it anyway. That memory lingers longer than a loss taken properly. Losses taken by the rules fade. Losses taken by ego stay sharp. The market will always offer another chart, another setup, another day. What it won't do is protect you from yourself. And the real danger is this: once a trader gets away with breaking a rule, even once, he files it away as proof that the rules are optional. The next time it's easier. The time after that, it feels normal. Before long, the rules exist only on paper, while decisions are made on impulse. That's when a trader stops building wealth and starts testing luck. I've seen men with modest systems outlast men with brilliant ideas simply because they honored their limits. They knew when to sit on their hands. They knew when not to trade. They understood that preservation of capital is a position too. Can you say the same about your last impulsive trade? The market rewards those who treat it as a business, not as a source of thrills. Rules are the operating manual of that business. Break them, and you're operating blind. Follow them, and even a bad day stays manageable. The moment every trader breaks his own rules is not dramatic on the chart. It's quiet. Most rule breaking starts with "just this once." Thinking. And that's the most dangerous phrase a trader ever whispers to himself. It sounds harmless. It sounds reasonable. It doesn't announce disaster. It doesn't feel reckless. In fact, it often feels intelligent. The market hasn't done anything terribly wrong yet, and you haven't either. You're still within shouting distance of your plan. That's why it works so well on the mind. The trader isn't abandoning discipline, he's only postponing it. Or so he tells himself. A trader rarely wakes up intending to betray his own rules. He sits down with the chart, reviews his levels, remembers his past mistakes, and promises himself today will be different. The rules are clear in the morning. They always are. But the market doesn't test you in the planning stage. It tests you when price starts to move and the clock starts ticking. Have you noticed how fast logic bends when the candle keeps pushing? Just this once usually enters the conversation when price is close but not quite right. The setup is forming, but confirmation hasn't arrived. Volume is decent, but not ideal. The trend is intact, but the entry isn't clean. Instead of waiting, the trader leans forward. He tells himself he's anticipating, not guessing. He reminds himself of the times he waited and price ran without him. And that memory becomes more powerful than the rule meant to protect him. The market has a way of replaying past frustrations at exactly the wrong moment. A trader remembers the move he missed, not the dozen he avoided by staying patient. The mind edits the record. It keeps the pain of missing out and deletes the quiet relief of avoided losses. That's why, just this once, feels like correction instead of error. It feels like growth. But growth in trading doesn't come from doing more. It comes from doing less, more consistently. Once a trader makes an exception, the rule is no longer a rule. It's a preference, and preferences are easy to ignore when emotions rise. The first exception rarely causes immediate damage. Sometimes it even works. That's the real trap. The market doesn't punish every mistake right away. If it did, no one would survive long enough to learn. Instead, it allows the trader to get away with it, and that success becomes evidence. Evidence that discipline is optional. Evidence that instinct is superior to structure. And the trader files that away. The next time the situation appears, the hesitation is shorter. The rule is still remembered, but it no longer feels absolute. It feels negotiable. The trader starts trading outcomes instead of process. He begins to measure decisions by whether they make money, not whether they follow the plan. That's when consistency begins to erode. Do you judge your trades by profit or by obedience to your rules? Just this once also shows up in risk. A trader knows his position size. He knows what a proper loss looks like. But the setup looks strong, and confidence creeps in. He increases size slightly, telling himself the stop is tight, that he'll manage it manually. He's still in control, he believes. But control in trading is an illusion once size exceeds comfort. The moment the position is too large, fear enters, and fear changes behavior faster than any chart pattern. A small violation in risk management has a way of magnifying every tick against you. The mind stops reading the market objectively. It starts watching the profit and loss instead. The chart becomes secondary. Decisions are no longer made by price action but by discomfort. And discomfort is a terrible advisor. How many bad exits have been caused not by bad analysis, but by oversized positions? The trader who makes exceptions often believes experience gives him that right. He tells himself beginners need rigid rules, but veterans can improvise. That's a comforting story, but it's usually backward. The longer a man survives in the market, the more he understands how little control he has. Experience doesn't remove the need for rules, it deepens it. The seasoned trader isn't rigid because he's fearful. He's rigid because he's been punished for flexibility. Another danger of just this once thinking is that it shifts responsibility. If a trade is planned and executed by the rules, the outcome belongs to the market. If a trade is improvised, the outcome belongs to the ego. Losses taken by rule feel like business expenses. Losses taken by exception feel personal. They linger. They demand revenge. And revenge trading is simply another rule violation wearing a different coat. The market doesn't care how good your reason sounded in your head. It only responds to orders. It doesn't know this trade was an exception. It doesn't know you promised yourself it wouldn't happen again. Price moves the same way regardless. The only thing that changes is the trader's internal state. And once the trader is unsettled, the next decision is easier to compromise than the last. Wealth in trading is built by removing decisions, not adding them. Rules exist to eliminate debate at the moment of action. The more a trader negotiates with himself, the less effective his rules become. Just this once is negotiation. It's the beginning of a conversation that should never happen during market hours. Planning happens before the open. Execution happens during. Mixing the two is costly. A trader who wants longevity must become suspicious of his own justifications, especially the clever ones, especially the ones that sound calm and reasonable. The market doesn't reward clever explanations, it rewards repeatable behavior, and repeatable behavior requires lines that are not crossed, no matter how persuasive the moment feels. Most traders don't blow up because of ignorance. They blow up because they slowly teach themselves that their rules are suggestions, and that lesson is learned one exception at a time. The first, just this once, is never the last. Rules are easiest to follow when there is no money at risk, and that's why so many traders believe they are disciplined when they are not. Sitting away from the market, everything looks obvious. Stops make sense. Waiting feels natural. Risk limits feel reasonable. A trader can point at charts from yesterday and explain exactly what should have been done. There is no tension there, no urgency, no consequence. The rules behave nicely when they are theoretical. The real test comes when price is moving and the position is live. When money is on the line, the market suddenly feels personal. Each tick carries weight. Each pause feels meaningful. The same rule that looked intelligent an hour ago now feels restrictive. Have you noticed how quickly a solid plan begins to feel negotiable once you're involved? Before the trade, discipline feels like wisdom. During the trade, it feels like restraint. After the trade, it feels like either regret or relief. The difference isn't the rule. The difference is whether capital is exposed. When there's nothing to lose, the mind is calm and generous with patience. When there's money at risk, the mind becomes a courtroom, arguing both sides at once, searching for permission to act. A trader reviewing charts on the weekend is a model of self-control. He sees clean entries, proper exits, and reasonable stops. He promises himself he will do exactly that next week, and he believes it. The problem is that the market doesn't trade on weekends. It trades when emotions are present. Rules are designed for emotional moments, not quiet ones. Yet most traders only test their discipline when it costs nothing. It's easy to say you'll cut losses quickly when you're not losing. It's easy to say you'll wait for confirmation when price is frozen on a screen. But once a trade goes against you, the rule suddenly feels like an overreaction. It hasn't really broken yet. You tell yourself, I'll give it a little room. And just like that, a rule that was absolute becomes flexible. Was the rule wrong, or did discomfort simply speak louder? The market exploits this difference ruthlessly. It knows, in its own way, that traders behave differently under pressure. That's why the same pattern that looked clear in hindsight felt confusing in real time. The chart didn't change. The trader did. Capital at risk changes perception. It amplifies hope when price moves your way and magnifies fear when it doesn't. Rules exist to neutralize that distortion, but only if they are followed when it hurts. Many traders confuse understanding rules with obeying them. Understanding is intellectual. Obedience is emotional. A trader can explain risk management perfectly and still violate it the moment a position feels uncomfortable. Knowledge does not equal control. Control comes from repetition under stress, and stress only appears when money is exposed. There's a reason paper trading creates confidence that live trading quickly dismantles. On paper, there is no fear of loss, no damage to self-image, no urgency to be right. The trader acts like a professional because there is nothing at stake. The moment real money enters, the trade becomes a verdict on intelligence, patience, and self-worth. That's when rules are challenged. A trader often believes his rules failed him, when in reality, he failed to execute them under pressure. The market didn't ignore the stop, the trader moved it. The setup didn't fail, the entry was rushed. Blaming the rule is easier than admitting the discomfort was intolerable. But rules aren't designed to feel comfortable. They're designed to protect capital when instincts become unreliable. Money at risk reveals priorities. It shows whether a trader values being right or being solvent. When there's no position, both goals appear aligned. When there is a position, they often conflict. Cutting a loss preserves capital but bruises ego. Holding and hoping preserves ego but risks capital. Rules exist to decide that conflict in advance, before emotion votes. A trader who only follows rules when it's easy is not disciplined. He is compliant until challenged. True discipline appears only when following the rule feels wrong, premature, or unnecessary. Especially unnecessary. The most dangerous trades are the ones where nothing feels urgent, yet the rule says act anyway. Can you obey a rule when the market hasn't forced your hand? The illusion of control is strongest when money is at risk. The trader believes he can manage the trade actively, think his way out, adjust on the fly. Rules feel rigid compared to clever improvisation. But improvisation depends on emotional clarity, and emotional clarity disappears the moment fear or greed enters. Rules don't rely on clarity. They rely on commitment. Many traders wonder why their back-tested results don't match their live performance. The answer is simple and uncomfortable. Backtests assume perfect obedience. Live trading reveals selective obedience. The difference between the two is not strategy, it's psychology under risk. Charts don't change between simulation and reality. The trader does. The market doesn't demand brilliance. It demands consistency. Consistency is impossible without rules that are followed when they are hardest to follow. When there is no money at risk, following rules proves nothing. When there is money at risk, every rule obeyed strengthens discipline, and every rule broken weakens it. The account balance reflects that over time, quietly and without opinion. A trader who wants longevity must practice discipline where it matters. Not in analysis, not in hindsight, but in execution. Rules are not there to be admired. They are there to be used under pressure. The market will always offer moments where breaking them feels justified. Those moments define careers. When the trade is live, and the numbers are moving, and the rule feels inconvenient, That is when discipline is no longer an idea but a decision. That is when rules stop being easy. Small rule violations quietly train bad habits, and that quietness is exactly why they're so dangerous. Big mistakes get attention. They hurt fast, leave scars, and force reflection. Small ones slip through unnoticed. They feel harmless. They don't trigger alarms. A trader barely remembers them the next day. And yet those small violations do more long-term damage than a single dramatic loss ever could. A trader rarely wakes up and decides to abandon discipline altogether. What happens instead is a series of tiny allowances. A stop moved a little farther than planned. An entry taken a bit early. A position held a few minutes longer than the rules allow. Each action feels insignificant on its own. The account doesn't collapse. The market doesn't punish immediately. And because there's no immediate consequence, the behavior feels validated. The mind learns from repetition, not intention. It doesn't care what rules are written in a notebook. It cares what actions are taken repeatedly. Every time a trader breaks a rule without consequence, the mind records it as acceptable behavior. Discipline weakens quietly, not with rebellion, but with permission. Have you noticed how the second violation always feels easier than the first? Most traders believe bad habits come from emotional blow-ups. In reality, they come from calm moments of compromise. The trader knows the rule, acknowledges it, and then gently steps around it. There's no panic, no rush, just a small decision that feels practical. I'll manage it manually. I'll give it a little more room. I'll fix it if it goes wrong. That tone of voice is not reckless. It's reasonable, and that's why it's dangerous. The market is an unforgiving teacher because it allows bad habits to form before it demands payment. A trader may violate his rules 10 times and make money 8 of those times. Those 8 successes build confidence in the wrong skill. He starts trusting his judgment over his process. The 2 losing trades feel like bad luck instead of warnings. The habit grows stronger while the risk remains hidden. Small violations also blur the trader's internal standards. The line between right and wrong execution becomes fuzzy. What used to feel clearly incorrect now feels situational. The trader begins making decisions based on mood instead of method. The plan is still there, but it's no longer the authority. It's a suggestion, and suggestions are easy to ignore when emotions speak louder. One of the most subtle habits formed by small rule breaking is hesitation. A trader who violates rules inconsistently loses clarity. When a proper setup appears, he hesitates because he no longer trusts his own framework. He's been improvising too often. The rules haven't protected him consistently because he hasn't allowed them to. That hesitation costs opportunity, and missed opportunity often leads to forced trades later. Bad habits don't announce themselves as bad. They announce themselves as flexibility. The trader feels adaptable, responsive, engaged. He believes he's reading the market better. But what he's really doing is reacting to discomfort. And reaction is not analysis. The habit being trained is emotional responsiveness, not disciplined execution. Position sizing is one of the first areas where small violations appear. A trader adds slightly more size because the setup looks good. The risk increase feels minor. The outcome may even be positive. But the habit being reinforced is this: size is adjustable based on feeling. Over time, that habit grows. What was once a small increase becomes a standard response to confidence. Eventually, size expands faster than discipline can contain. Stops suffer the same fate. A stop moved once doesn't feel like a betrayal. It feels like judgment. The trader tells himself he's avoiding noise, but the habit forming underneath is avoidance of discomfort. Each time price approaches the stop, anxiety rises. Instead of accepting the loss, the trader adjusts. He trains himself to escape pain rather than respect risk. That habit doesn't disappear when the loss grows larger. Small violations also distort memory. The trader remembers the times breaking the rule worked and forgets the times it didn't. The mind edits the record in favor of ego. Over time, the trader builds a narrative that he is better discretionary trader than he really is. The habits grow quietly while the self-image grows confidently, and that gap eventually demands correction. The most dangerous part is that these habits feel earned. The trader believes experience justifies them. He's no longer a beginner, he tells himself. He's allowed to bend things. But experience in the market doesn't remove risk. It only reveals how constant risk really is. The veteran who survives longest is usually the one who tightened rules over time, not loosened them. Small rule violations also erode emotional resilience. When losses finally come, they feel heavier because the trader no longer knows whether he followed his process. Was the loss unavoidable, or was it caused by poor execution? That uncertainty adds stress. Stress leads to more impulsive decisions, and impulsive decisions reinforce the very habits that caused the problem. The market does not require perfection, but it demands respect. Respect is shown through consistency. A trader who respects the market does not test boundaries casually. He understands that habits form whether he intends them to or not. Every click of the mouse teaches the mind what is acceptable behavior under pressure. The account balance reflects habits long before it reflects intelligence. Two traders can use the same system and get wildly different results based solely on execution discipline. One allows small violations, the other doesn't. Over time, the difference compounds quietly, just like the habits themselves. A trader who wants longevity must become strict with small things. Not dramatic things, not emotional things, small things, because the market doesn't destroy traders with one bad decision. It allows them to slowly become someone who makes bad decisions naturally. Habits are built one trade at a time, and they don't ask permission. Emotional trades often look logical in hindsight, and that illusion is one of the market's most convincing tricks. After the trade is over, the chart settles down, the noise disappears, candles line up neatly, support and resistance seem obvious. What felt chaotic in real time now looks orderly, almost inevitable. The trader looks back and says, "Of course that happened." But that calm explanation didn't exist when the decision was made. In the moment, emotional trades rarely feel emotional. That's the part most traders misunderstand. They don't feel reckless or panicked. They feel justified. They feel explained. The mind is very good at building a logical story around an emotional impulse. Fear doesn't say, "I'm scared." It says, "This level might break." Greed doesn't say, "I want more." It says, "The trend is strong." Have you noticed how emotions borrow the language of analysis? When a trader is in a position, the chart stops being neutral. Every candle is interpreted through the lens of profit and loss. A green candle confirms intelligence. A red candle questions it. The trader begins to seek information that agrees with his position and dismiss information that doesn't. That bias is emotional, but the conclusions sound rational. That's how emotional trades disguise themselves. After the trade is closed, the mind rewrites the experience. It connects the entry to a visible pattern. It assigns meaning to random fluctuations. It explains exits as strategic rather than reactive. The trader remembers the reasons that make him look competent and forgets the feelings that made him uncomfortable. This selective memory is why emotional trades are so hard to identify later. A trader might look back and say he bought because of support, but forget that he bought early because price was moving fast. He might say he held because of the trend, but forget that he ignored his stop because he didn't want to take the loss. The chart provides just enough structure after the fact to justify the decision. The market doesn't argue. It just sits there, silent, allowing the story to stand. This is why journaling feels unnecessary to many traders until it's too late. Without records of thoughts and emotions at the time of execution, hindsight becomes the only narrator. And hindsight is biased toward making the trader feel reasonable. The mind doesn't like admitting that a decision was driven by impatience or fear. It prefers to believe it was driven by insight. Emotional trades are often triggered by timing pressure. Price starts moving without you. The chart that was quiet suddenly becomes active. The trader feels urgency, not because the setup is complete, but because opportunity feels scarce. That urgency pushes him into action, and the mind quickly assembles reasons to support it. Later, when the trade is reviewed, those reasons remain, but the urgency is forgotten. Losses caused by emotional trades are especially confusing. The trader looks back and sees a logical setup that failed. He concludes the market was unpredictable, or the strategy needs adjustment. He doesn't see that the real failure happened before the entry in the decision to act without full confirmation. The emotional shortcut is invisible on the chart. Even winning emotional trades are dangerous. They reinforce the wrong lesson. The trader believes his instincts were sharp, his read was correct. He doesn't see that the profit came despite poor process, not because of it. That success builds confidence in behavior that cannot be repeated reliably. The market occasionally rewards bad habits, and those rewards are costly over time. Hindsight also removes uncertainty. In real time, the future is unknown. Multiple outcomes are possible. After the fact, only one outcome exists. The mind forgets how many alternatives were present at the decision point. It compresses uncertainty into inevitability. That compression makes emotional decisions look like foresight. A trader reviewing a chart days later is not the same trader who placed the trade. The emotional state is different. The risk is gone. The outcome is known. That difference matters. Decisions made under risk cannot be judged fairly without remembering the emotional environment they were made in. Otherwise, the trader learns the wrong lessons.